Welcome to the Evolution Partners podcast, where I talk with the world's leading thinkers, planners, and doers who are helping to build great companies in their own way. We learn how the work they're doing is creating an impact and get to know a little bit more about them and what makes them tick. This episode is brought to you by Evolution Partners, where we help leaders to confidently build enduring great companies using our proven, structured, strategic planning process that ensures you build and execute the right plan. Check us out at evolutionpartners.com.au. Also, you can check out our books, Made to Thrive, outlining how to be a great CEO, as well as Onboarded, which is about making your new hires more effective faster. Greg Crabtree is a speaker, author, entrepreneur who has simplified financial reporting and empowered all entrepreneurs to really understand and take ownership of their finances. Greg is the author of Simple Numbers, Straight Talk, Big Profits, and Simple Numbers 2.0, Rules for Smart Scaling. He has also contributed to Vern Harnish's book, Scaling Up. Greg chairs the EO at Wharton Executive Education Program and is a trainer in the EO Accelerator Program. You can find Greg at simplenumberscri.com. Greg, what I see in you is someone who is passionate about helping people to understand how the way they're using the data in their business is often inadvertently leading to poor decisions and poor investments. And that if they use the data better and treated their business more like an investment, they would be much better off. If this resonates with you, please tell us, how did you come to be in this place?
Well, Brad, first off, thanks for having me come on, and happy to talk to your community, about it. I mean, probably I came to be here by being a frustrated accountant, because I'm probably not the most typical accountant. Most people have actually given me a compliment by saying I'm not like an accountant at all. I endured learning the concepts, but there always seemed to be more. And I think, joining EO in 2001 got me out of the accountant mindset into the entrepreneur mindset. Yeah. And then through various processes that we all learn in, obviously working with, people like yourself that help coach and you look for your purpose. My purpose got clearly defined fairly early on as, my purpose is to elevate the entrepreneur. And so you start there and then you work backwards and saying, well, how do I do that? Well, it's certainly not preparing tax returns and producing financial statements based on generally accepted accounting principles and international financial reporting standards. It's really finding out what is it the entrepreneur needs and then finding a way to serve that need and be profitable, because I've got to be an entrepreneur myself. I've got to run a profitable business. And then once I've solved step one of finding need, two, can I be profitable? The third thing is I just got to tell everybody about it. And so obviously, one of the things that, you have to find out is if I'm going to do what I do now and what my team now does, we transformed ourselves from $1 million local accounting practice that did tax returns and financial statements and some bookkeeping to we're now a $7 million practice unit of a national firm that 95% of what we do is not in our local market of Huntsville, Alabama. Our clients are all over the U.S., Canada, Australia, a few dotted here or there around the world as well. And, and when I tell that to other CPAs who have an idea, they think they want to get into consulting just because they hear that it's not preparing a tax return or not, filing a financial statement, but it blows their mind that I don't go to lunch with bankers or lawyers to get clients. I do things like this, and I write books. But if you write a book, what are you going to write about? I mean, it's nobody's going to read a book if you sit there and talk about accounting principles. Those have been written and probably need to be burned for the most part. Because the reality is accounting principles for entrepreneurs hasn't evolved since accounting was created in the 1400s by Pacioli. Yeah. So it's like, okay, there's more here. What is it? And so really I started studying the data, which I did the one thing that no accountant's ever going to do. I started studying data that nobody was going to pay me to do it. And
yes,
that's I mean, accountants just don't think that. Somebody's got to pay me to do this. I'm not going to do this. Well, dummy me, I did. Well, guess what? It turned into a book or 2 books and turned into being recognized as, you can call it an expert if you want to call it that. At the end of the day, I grew up on a chicken farm in Alabama, gathering eggs for a living from the time I was 6 years old till I went to college. So I figured it was a lot better than gathering eggs. But I learned from my clients in reality, and I learned from other entrepreneurs. And my first EO forum was enlightening. I said, I couldn't do business with them because of forum rules. And I said, well, what is it that we're not doing as a profession? Because when I asked them how many of them would recommend their current accountant, the answer was 0.
Yeah.
Okay. Well, that's from an NPS score. That's a failure as an industry. And I think to a large degree we have failed the public as an industry, from that standpoint. And what they told me, really was, 1, they don't like the tax day surprise. Okay, I can figure that out. Number 2, they wanted to be billed on a fixed price basis rather than by the hour. But the third thing was the eye opener. They said, oh, by the way, you see the most intimate details more than any advisor, the bankers, attorneys, spouses. I see more data than anybody in the ecosystem of entrepreneurs. I should have some idea what works and what doesn't.
Yeah.
And that's not the mandate that we were given in college. That's not the mandate I was given from my first, job, in accounting. And, it's like, dang, we missed the mark. So I'm doing my part to say, my goal is to elevate the entrepreneur. So what are the things and where do we start? And it started with aggregating data sets and going to the data with a fresh question of what is it going to tell me, rather than going to it with a proof text.
Yeah.
And we developed the simple numbers P&L structure, which the unique thing to us is we see every business, regardless of industry, in exactly the same format for balance sheet, P&L, cash flow. So 1, it allows us to aggregate data much, much easier. But number 2, it gives my consultants an ability to communicate and let the data tell its story because it's consistent. And then we can get groups of companies together that are in the same industry and they can all speak the same language. But here's the other part. We can get groups of people together in different industries and they can have the same discussion, even though they're not in the same industry. And that is the massive, massive failing. When you and I were at a conference recently where there's 100 people in the audience.
Yeah.
If you had everybody in that audience take out their P&L and put it on the table, none of them would be in the same structure unless they were one of our clients.
Yeah. Yeah.
And that is a massive barrier in understanding.
It really is. It seems to me that most accountants produce data for the purpose of tax department compliance. It seems as though
banking.
Yeah, or banking. And they I don't know if they enjoy being in that world, but they live in that world. Whereas the entrepreneur on the other side of the ledger, let's say, is desperate for data that can lead to good decisions, because so much of the data that they get leads to bad decisions or decisions that aren't based on data. What I love about what you've done is you've managed to structure financials in a way that they're actually useful for entrepreneurs. Can you tell us a bit about that?
Yeah, and so there's 2 aspects. 1 is structure, but 2 is the story. And the story comes in 3 elements. First and foremost, I need to see the most truthful story to be told, once it's structured correctly, is rolling 12. Every month ends a 12-month accounting period. I have no seasonality excuses. And I can't tell you how many times I have shown rolling 12 data to a management team on a call and somebody utters this statement, well, that just happens this time of year. No, it doesn't. This rolling 12 has every time of the year in it. I mean, it's like their brains are so wired to the excuse mechanisms of why we didn't hit our target.
So that is starting in May last year and ending in May this year, for example. That's the rolling 12.
Starting in May and ending in April. So,
that's right. Yep.
Right. Yeah.
Thank you.
And so every month ends a 12-month accounting period. So Our standard presentation to have a call with a client, which I sat there and did all day today, is we look at rolling 12s of this month, this year. So we're reviewing March data right now. And so we're looking at March rolling 12 against March a year ago rolling 12 against March 2 years ago rolling 12.
Yep.
Now, our model is also set up to where we can expand how long of a time we want to look at if we want to. But we find the first thing we want to look at is year over year, the last 3 years. Then we're going to look at rolling 3, March, which is January to March, and for this year, last year, and the year before. And then we're going to look at March the month last. And this is my psychological argument of that sequence. If I start with monthly data, it's the highest probability of having variations and anomalies because it's a short period of time. And people just aren't great bookkeepers, no matter who you are. And so the first data that I look at for a month is going to have the greatest impact in my thinking. If I start at the monthly level, I can never get my head to the rolling 12 level. So we want to start with the most authoritative number first and then work our way down to the nearest term last in the shortest time period. Now then we flip over to the next tab and we're looking at trend data, which is rolling 12 this month versus rolling 12 last month versus rolling 12 2 months ago. And that's telling you that is actually the direction of the business. I can forecast my client's data better than they can because I'm not married to it. Yeah. I am looking at rolling 12 data trends and plotting the next data point. Because unless you tell me you're going to overtly do something different, the trend data is plotting the next data point without a change in action.
Yeah, yeah.
And it's same thing.
Yeah. So 2 books, simple numbers, I'll call it number 1, simple numbers 2. The trap, and take this for what it's worth, is that these look like similar books, the same color, similar name, but I want to just say to the audience, these are vastly different books, and it's the second book builds on the first one. And the second book, I really feel every entrepreneur should read it. They should be forced to read it before they get their business license. And they should, if they don't understand it, they should read it again. And I, to be honest, I read a lot, and I wouldn't say that a lot about a lot of books. I want to pull one quote out of the second book to ask your kind of comment about that. As entrepreneurs learn to view their business as an investment vehicle that must provide a return to their investor, they see the enormous power of a privately held business to realize 50 to 100% returns from their invested capital year over year without selling the business. What I love about that is that I've seen many people sell their business and then go out and invest in, I don't know, property perhaps, and get an 8% return. Yeah. Whereas they were just getting yeah, they were just getting 50 to 100%, but they can't see through the clouds. Can you tell us about this?
Well, that's a failure of the accounting profession. We do an awful job of teaching balance sheet concepts to entrepreneurs because it takes some effort. And guess what? Accountants aren't really good at explaining the balance sheet. And once again, this goes back to balance sheet presentation has not evolved since the 1400s when accounting was created. And so therefore I looked at it, and this really can't, I got to give great credit to David Wessels, who's the lead professor at Wharton Business School in our executive ed program that EO and Wharton does together. And they're gracious to let a chicken farmer like me actually present one of the days of the class. But David and Gad Allen are just wonderful, talented professors that I've learned a lot from sitting under their teaching. And in one of the first years, David is teaching this concept of return on invested capital, and I'm just kind of sitting in the back of the class, the first year like everybody else, and go, I don't do that calculation. And so, I did have some interchange, and so I actually contributed to some of David's thinking in this, in the sense that, when he's going through essentially invested capital, just think of it like this. Take equity. And he'll make the statement: equity is a flawed calculation. So, most, especially in entrepreneurs and in non-public companies, we got all kinds of trash on our balance sheet. Yeah, we're horrible balance sheet managers.
Yeah.
So, an invested capital is taking equity and removing non-operating assets that have nothing to do with running the business, things like goodwill, intercompany loans, shareholder loans, all that crap.
Yeah.
Moving, same thing on the liability side for the same thing, and getting down to true operational equity of the business.
Yeah.
So that's invested capital in a simplistic definition. Now, in public companies, you don't include cash in invested capital. And so David said that, and I raised my hand in the back. I said, why's that? And he says, well, public companies can raise cash anytime they want by issuing stock. And I go, excuse me, we can't do that. We're private businesses.
Yeah.
And so we had a great discussion, and he now teaches my 2-month core capital target concept is you have to include your 2 months cash as a private business in your invested capital calculation.
Yeah.
And so that was a really great learning. And so after that first class, I go up to David and I go, hey, I got all this private company data to look at this issue, because at that time I didn't have the 50% target in mind. I didn't know what the number was going to be. And he really didn't show any interest in doing something that he wasn't paid for. like I said, the accountants were, says, okay, I'll just study it myself. And so that's when I came up with the core data set that I used for the second book.
Yeah.
And it's like, dang, I mean, the minimum return on invested capital was 50%. And, and I've yet to find a business yet that I couldn't get to 50% return on invested capital with proper operational, procedures. Now there's people that are below it, but it's by their choice. It's not by mine. Or by,
so there's the return on invested capital. But what also come out of your data set that you just spoke about, which is, I think, $1 billion worth of small to mid-market business revenue within your client data pool, is that it's also the growth, which I think, correct me if I'm wrong, was 14 to 19%. So you've got a much higher return on invested capital comparable to dividends in a listed company.
Right.
And you've got growth rates of 14 to 19% where they were nowhere near as high in the standard stock market.
Yeah, and now that was the case from my base year was 2013, and that was the case all the way up to 2019. And then you had the COVID years that created all kinds of disruption that, you got to throw out 2021 and maybe a little bit of 22. Now we've seen the growth rate really plummet in 23 based on our data set. We're probably 3% overall growth in 23. We're trending about flat to that number, and those are non-inflation adjusted numbers. So the reality is we've got negative growth at the time. The government struggles to calculate true inflation. I mean, it's just a tough number to calculate, but our data is proven to be pretty accurate. And I contend that, pretty much from 2009 to 2019, that was the greatest growth of the developed world's economies, and definitely the U.S.'s, but I think Australia, from the data I've seen from my clients there, the data I've seen from the Canadian clients that we've seen, those were massive, massive growth periods, largely because that was the tail end of the baby boom generation. But we've now, with population demographics, hit the wall in terms of productivity, because I'm squarely on the side that it takes labor to create production. And there's two bad things about labor right now. One, there's not enough of it, so we've hit the theory, we're not seeing growth in the total pool of available workers. And then secondly, people are producing at the lowest rate in my career. I mean, the output, and it's hard to measure service industry output in a lot of cases. I can measure my manufacturing clients' output a little bit better. But in the service industry, what people are getting done versus what you're having to pay for is just it's gotten worse during COVID. It's maybe stabilizing a little bit at the moment, but it's a tough market right now for that.
Yeah. You mentioned earlier on then the core capital target, which is 2 months of fixed expenses.
Plus all labor.
In a bank. Yep, plus labour in a bank account. First of all, on behalf of my clients, I owe you a debt of gratitude because since the first book, we have absolutely drilled them on that concept, and it has frankly saved more than a few businesses. So thank you, first of all, because they've had the liquidity to weather the storms. They've had the cash to weather the storm. So thank you for that. Now, in the second book, you've either changed it or you've called it buffer capital. And can you just share the difference between those two, and then why core capital target is so important?
It's the same definition. I chose to, it's kind of one of those, you're making decisions when you're writing things as to how to name the baby. Essentially, but it's the same. Core capital target and buffer capital are synonymous. And so what I was trying to do in the second book is condense the balance sheet into 3 numbers. The balance sheet is don't think of it as assets on the left and liabilities and capital on the right. It is, I've got 3 components of capital. I've got my buffer capital or core capital target of the 2 months with nothing drawn on the line of credit. I'm taking my trade capital, which is traditionally working capital by the classic definition of current assets minus current liabilities, but I exclude cash and debt. And that's important that has to come out. Cash and debt should never have been in the working capital calculation, in my opinion, because those are choices. What aren't choices, I can influence them, but I can't totally eliminate them, is AR, inventory, work in progress, minus accounts payable, accrued expenses, deferred revenue. And and all I do, Brad, is I try to find ways to present data that changes my client's behavior. So I'm only successful when I get my client to act differently in their best interest. And so I did the traditional, like my good friend Alan Miltz, who we've done a lot of stuff together. We both wrote chapters for Vern's book, and we've co-presented in a lot of places. And Alan's got wonderful, wonderful material. And I was listening to actually one of Alan's presentations that we had a joint presentation with one time. And a lot of this idea of trade capital kind of percolated while I was listening to Alan speak. And the way we kind of talk about each other's stuff is he is higher level and I'm the next level of detail down. And I just had this little brainstorm of as he was describing, working capital, in his presentation, of separating out the cash and the debt piece and then netting the asset and the liability together to look at one singular number, which he does somewhat in his presentation. Yeah. And I thought that was brilliant. And then when I take that and relate it to my rolling 12 revenue, all of a sudden I've got an immediate predictor of the cash burn or cash creation of growth. And then the only thing that then counterbalances that is my profit equation as well. And so if I'm looking at trade capital of 10% as a percentage to revenue and my profit is at 5%, if I grow $1 million, I'm going to burn 5% of cash before I get the first free dollar that I can use. Versus,
which is so important. Which is so
important.
But
see, here's the thing though, Brad, that just shocked me. Once I started showing that number to my clients on a monthly basis and monitoring the trend, so my presentation shows them the last 12 months of month to month to month, is trade capital going up or down, and what is that as a percentage to revenue and compared to profit. They started, if they're, they picked the one they could affect. If I can't change trade capital, I got to change profitability. If I can't change profitability, I got to lower trade capital to meet that profit number that the market's going to let me get. And if I can do both and flip it, all of a sudden I've gone from a cash burning engine to a cash creation engine. And I'm creating capital with every new transaction, which is phenomenally important.
Yeah. That's the thing that a new entrepreneur has to understand, but no one does, is as you grow, and Alan Miltz does this to your point quite well, as you grow, are you sucking cash or are you spinning off cash? Because if you're so excited about growing revenue and you're going to need $400,000 to do it, You've got to know that right at the outset, because where are you going to get that
Well,
money from?
but I think part of it too, though, it led to an understanding that we can't make these things. The concept is universal, but the results aren't. And so there are businesses that fit certain capital profiles. And so I'm either a capital heavy business, a moderate capital business, or a capital light business. And I can't take some of these concepts of a business that just does not pay you in advance. And a business, I always say the hardest business to capitalize is if you carry AR and inventory. That is one of the hardest businesses to get above 50% return on invested capital. If I carry one of the two, I can kind of get to 60 to 75% invested capital. And if I don't carry either one of them, I get paid in advance. I don't have to carry inventory. I should be 100 to 150% return on invested capital, as a business. And it's amazing, and it's more important, I think, for the businesses that have light capital requirement, that they underperform to their return targets because they listen to somebody who has that capital structure and they don't understand. Listen, no, you need to be up here. You're not aiming high enough.
Yeah. I want to just take one step backwards to the core capital target and ask a very specific question about line of credit. Because what we often hear, especially from the CFO, is, we've got 2 months fixed expenses cash at bank because we've got a $2 million line of credit, and therefore we've got whatever the sums are to equate that. Now, you specifically address that in the book, but I know that there are many people who are in that situation who view the line of credit as a part of the core capital target. Any comments on that?
Just wait till there's a banking crisis and you don't have a line of credit.
Yes.
I got news for you. Every 7 to 10 years, there's a banking crisis, a liquidity crisis, and the bank pulls the rug out from under you, and you've lost the game of Russian roulette. And that bullet goes through your head, and your business is out of business. And you had a good business. You were just foolish to think that you could trust the financing source, because every line of credit that has been issued in the last 50 years has a call provision. And banks call good loans when they are forced by regulators to drop their debt to equity or debt to deposit ratio or debt to equity, or either one. So the banks have limits. And so when you get into a banking crisis, this is what the general public doesn't understand this. The people they go after to fix the bank are not the bad customers. They go after the good customers because those are the only ones that can do something about it.
Yeah. When you need them the most is when they're most likely to pull that funding.
Yeah, exactly.
And so I want to now just go back to return on invested capital. You say in the book it's a great era for entrepreneurs to not think like an investor. Right. And then you just spoke about the 50 to 150% return on invested capital. And I just remind listeners, this is against an 8% return in real estate. So this is a fantastic investment, most likely your business. But what I love, in the same way that you set the bar of the core capital target, saying 2 months of operating expenses cash, in the return on invested capital, you said, look, the absolute minimum is 50%. Can you tell us about the 50%?
So it's a pre-tax number, and so one, I'm trying to filter out the world's variations of taxation, and so just think of it like your business is, if you got $1 million invested in invested capital, in your business, and I should be making $500,000 of pre-tax profit. Simple as that. And so it's like a 50% certificate of deposit or a money market account. Who wouldn't want that? And so that is the real issue of it actually that's the return you get. And I wanted it to, public companies, when you see public data, they actually show the after-tax return on invested capital. So if you try to compare yourself to a public company, just understand theirs is after-tax, which only bumps it up. The corporate tax rate in the U.S. is only 21% federal. And they've got all kinds of stuff that the games that they play. So you're probably talking about a 25% bump up in that rate if you actually went to pre-tax, in that. But like I said, I just looked at the data and said I didn't go with a proof text of I needed a number to prove. I just, well, tell me what that number is, and then what it ultimately. So kind of think of it in terms of the way that like I showed you guys in the presentation that you and I were both at, is we set our first corner of the foundation at the return on invested capital of 50% or higher, or kind of based on what your capital profile is for your business model. And I'm going to set that return on invested capital first, which tells me what your profit percentage would be, but not your profit percentage to revenue. I'm looking at profit percentage to gross margin. When we look at profit percentage to gross margin, it puts all businesses on the same level comparatively. It's why we don't use that measure. Like I said, it's a lot of small thinking in the accounting space, because they just don't understand it. But gross margin should really be the true economic top line of every business, not revenue.
Oh, absolutely. And equating it to other businesses is not important for the purpose of competition, but comparison, so that you can see how well your investment is performing. That's kind of what I'm seeing there. I want to just take one step backward. You mentioned this briefly, trade capital. Most entrepreneurs, I've always found, really struggle to understand working capital as a simple measure of how much cash they need to grow. We've spoken about that. You introduced and spoke about today the concept of trade capital.
The balance sheet is that sheet they don't look at. I mean, they're P&L focused, and you can't. You've got to learn to look at the balance sheet. But what we've got to do better as practitioners to give them a balance sheet that actually communicates the right concepts. And that's on us as the profession. We do a horrible job of presenting that. And we typically just stick a balance sheet in front of them. Maybe this year versus last year. No. Now, when I show a client a balance sheet, we're looking at the last 9 to 12 months balance sheets, column to column to column to column, and we're looking at it moving across time and saying, what are these accounts doing? Because one of my favorite phrases, I say, all the dead bodies in your accounting data are on the balance sheet. Everything wrong with your data is on the balance sheet.
Sure. Yeah. All of your bad decisions, all of your good decisions, all the risks.
But also all of your errors.
Sits there and
every error, everything that is messing up your P&L not being right is on the balance sheet. Because there's a fundamental rule in accounting, and this is physics. If I get the balance sheet right at the beginning of the period and the balance sheet right at the end of the period, net income has to be right. It cannot be wrong. But if we don't apply that rigor of validation it doesn't have to be perfect, but it's got to be reasonably close. But, the sloppiness and lack of understanding of that is just, it's just rampant across most small businesses. Well, it's even rampant in some of the big businesses too. Sometimes the big businesses do it by intention. They know the answer, they just don't want to accept the truth. Every financial fraud that has happened on the balance sheet. It's where they're overvaluing assets, undervaluing liabilities. That's 100% of all financial error.
If we think about our businesses as investments, and we think about the people who work for us in our business as an investment within an investment, then we must consider that overall the return on investment. We spoke already about the labour efficiency ratio. Can you tell us a secondary measure that you've spoken about from the labour efficiency ratio, which is gross margin divided by the labour cost, is the career labour efficiency curve. This is a fascinating concept.
Can be painful.
And it is how labour...
it
can be brutal, I think, Can Tell us about the career
Yeah,
labour
and
efficiency
so,
curve.
so think of it like this. There's 3 zones to an employee's life with you. There's the training zone, which is where, it can be short, it can be long, but whatever length of time it is, it's where I'm paying the person more than what they're producing. And so they're not to a contributing role, they're actually costing me money. The moment it breaks even, I go into what I call the chasing zone. And I call it that for a reason. Fundamentally, a successful business, they're going to have their producers pay chasing their performance. So performance happens first, pay follows. The moment that I have to give pay and let performance chase a pay, I've gone back to the training zone. I've gone backwards.
So they're unprofitable as a trainee, then they transition to be profitable as an employee.
And then they're chasing. And typically, the way most of them work, they're going up. So, production goes up, the pay chases it. And then I get to an apex. And, every career cycle has its point of when does that person's productivity plane out. Now, their rate may be going up of performance, but they just perform less. And I keep giving them raises, and their pay keeps going up, but their productivity doesn't get more productive. And there gets to be a point that margin just shrinks, and then it flips again. And when it flips again, that's called the replacement zone. And that's where nobody wants to go. But we see it in professional sports all the time. In the book I use, in the Simple Numbers 2.0 book, I use the example of a famous baseball player in the U.S., Jason Varitek. And in labor efficiency for baseball, there's a wins above replacement is a great metric they use in baseball. And so in Jason's early part of his career, his wins above replacement, stayed above his pay. And then they finally won the World Series in 2004. He got a big contract increase, and then all of a sudden his productivity started to fall. He's older. He's gets injured, and you can see the difference of what his wins above replacement were above his salary in the front part of his career. All that white space negates what they wasted on the backside of his career with a bad contract and bad performance. And they end up, they did win a World Series, but then they fell on hard times after that point. And he's a very beloved baseball. I was a big fan and still a big fan of Jason. But I found it to be an extremely interesting, useful presentation of you see this play out in sports. Well, we see it play out in business every day. We've got clients in high billable, high technical positions. But the trend that we're seeing now is people are realizing that pay of the high technician, I can't create enough margin for that person to make it worthwhile. And so unless they can manage more of the younger people and lower cost people, if they're just a high end producer, they got to go. And we're seeing a trend of where, whether it's in the trades business, if it's in the technology businesses, programming, software development, they're letting the high end people go to the desperate people in the market, and the profitable people are resetting their salaries and working their way up the labor efficiency curve for their career.
It's a fascinating concept because we think the trainees or the younger trainees are the unprofitable ones. But as soon as you read it, you think, well, that makes so much sense. These people are getting paid so much more because every year they want a pay rise, but eventually there's a break even and then a loss position where it makes more sense to get rid of an older, more experienced.
Well, it's really kind of the curse of the entrepreneur. So the entrepreneur tries to go the easy route and hire the expensive people who don't need to be managed. Well, that's a flawed theory in and of itself because everybody needs to be managed regardless of your pay rate. And so they structure a business that has expensive direct labor and they have a skinny management labor structure. Well, as that direct labor gets more and more expensive and margin shrinks, they start to invest in management labor. Oh, we got to create, we got to do things differently. Well, but you've got too expensive of a workforce up here. And so as I told the group, there's 3 labor strategies, and they have to play off of each other. If I have expensive direct labor, I must have less dollars spent in management labor than my peers. If I have inexpensive direct labor, I have to have more cost in management labor to support what the direct labor doesn't know. I can take a blend of the two and kind of be midpoint between the two. The dangerous aspect of when you go expensive direct labor is I have nowhere to go. I actually will be a dying quail headed off into non-profitability because those people will continue, because of the career labor efficiency curve, they will continue to get more and more expensive and less productive. And the market just won't let you bill for what their pay increase is. And I get it. I mean, people want to say, oh, I want to work here forever. Well, it's not economically feasible for you to work there forever. I'm sorry. I mean, it's just not the way economics works.
No. Greg, what's the difference between a budget and a spending plan?
Yeah, a budget is the word I'd love to stamp out of finance. I mean, I consider a budget a license to spend versus if you look at a spending plan or a forecast, the idea is I want to be adaptive. And so the idea is pick what is the indicator that tells me that we need to keep increasing a cost to match movement up or down. If I have a budget, I'm going to spend indiscriminately regardless of what activity happened. So if I grow a business, I need to invest in more direct labor. I can't just keep doing it with the same people and run out of, and I can get away with it for a little while, but I'm running people hot. And one thing about the direct LER and the management LER concepts is it gives you a mathematical measure that as you monitor it over time, when am I hot and when am I overstaffed? And those become guideposts of actions of when you can trigger, do I need to add, do I need to pull back? And almost even like in the pro sports world, we can use labor efficiency targets as salary caps. Hey, I can only spend this much for labor. Take your pick. Do I spend it in management? Do I spend it in direct? But I can only spend this much in labor, period, for this amount of margin production. And it gives entrepreneurs a fuller palette to be creative and make decisions of structure, because every team's different. I mean, like I said, it's almost like I would really rather my clients interact with non-industry people to get creative ideas rather than within their industry. I think industry groups are okay, and we do a lot of industry group data sharing and data comparison, but I really push everybody. You need to be in at least one non-industry group if you're going to be in an industry group. You need both, I think.
Yeah. And a non-industry group would
be or a mastermind.
Example, or
we actually have a mastermind with our clients that are not in the same industry, and because we share their data in the same format, they can all understand each other's businesses far better than anybody else, because they've all follow the same concepts. And so, like, you could take your coaching clients that are in dissimilar industries, and you would get them together in a mastermind to share data, even though they're not in the same industry, and they would benefit greatly from that, I think.
Awesome. That sounds fascinating. So the book that I'm writing at the moment is about building a better business rather than a bigger business. So the working title is Bigger Isn't Better, Better is Better. So for you, what do you think that a better business looks like?
Well, I think there's a reason why I call the 2.0 book. I could see this even back when I was writing the 2.0 book, which occurred mostly in late 2018, 2019 was when most of the manuscript was written. I didn't know COVID was coming, but COVID actually didn't have anything to do with it in reality. 2019 was when our data showed that the U.S. economy ran out of labor in the fall of 2019. We would be in the same labor crunch right now whether COVID happened or not. So it was just a canard that confused everybody. And I could sense then that the idea is, yes, we get into organizations like EO and any other business group, and it's grow, and you got the Inc. 5000 and blah, and it's like, well, I can show you a lot of companies that grew that wish they didn't grow, that it was a bad idea. And so that's why I called it smart scaling. Yeah. Well, I think now And this is the thing that everybody's got to understand. I mean, we've come off of what I call the participation trophy economy. We thought that we were really good at growing businesses from '09 to 2019 and even into some of the COVID era as well. But those days are over. I mean, we're now into what I call the street fight economy. So during that year of 2009 till probably 22, we were trying to maintain our share of market growth, maybe get some market share, but we were just happy. The market was growing so much, we were just thrilled that we were getting our share of the market growth. Well, now that the real market, in my contention, really isn't growing, and I think my data shows that, you've got to go get market share. And so who are you going to go punch in the mouth and take their customer away from them and gain market share? And now, in some cases, and I credit this with David Wessels at Wharton, David, tells each class, sometimes you need to change your where, not your share. And I think that is a very good statement for people to think about that want to grow their business. Because I changed my where, not my share. I mean, I couldn't be doing what I do today if I focused only on Huntsville, Alabama. I mean, the market is not big enough. And they look at me as like, oh, I'm just a local CPA. What do I know? Well, guess what? When I leave town, I'm an expert. So it's like it's more fun to leave town. It's just no fun to actually deal with somebody locally for the most part. I got a few, that I love and they get it, but it's like, it's just not worth it. And so from that standpoint, look at all your businesses and say, do I need to change my geography? And that there's some risk in that because sometimes, you go into markets you don't know. And it was a lot of unknowns for us. I mean, but actually it's been actually quite easy, in reality. But you've got to look at those things and make those strategic decisions and say, is it worth it? But you're absolutely right because, I talk about in the first book, the black hole. Black holes between 1 million and 5 million. Yeah. The deepest, darkest moment of the black hole is at 3 million. And I can't tell you how many businesses run up to that 3 million and hit the wall because that's when you have to hire more management labor than you can afford. And you diminish profitability, which sucks out cash flow, and you've only got one shot to make it, or else you have to back the truck up and get back to 2 million or 2.5 million, get healed, build up some capital, and make the run again. And once you get through to about 4 million, the clouds start to clear and the skies part, and then you can tell there's a significant difference to that. But I mean, I'm telling you, that $3 million mark is just so real that it's amazing how many people have run up against it.
So a better business is one that has the ability to. You're trying to summarize what you're saying there. The ability to grow in a fashion that is controlled by the entrepreneur.
Well, somewhat, but also, so let me state it another way or another factor as well. The market is going to come in uneven movement. There's times it's going to come against you, and you've got to be able to pull back. And it's times it's going to open up and give you a moment of opportunity to run, and you got to be ready to run. And then you have to be ready to stop when it stops giving. And so the first step in the simple number strategy cycle that we use is assess market conditions for growth and profitability. There's times the market will let me grow, but it won't let me be profitable. There's times it'll let me be profitable, but it won't let me grow. And I've got to put on my glasses and that look differently at accessibility of market share and what's it going to cost me, and is it a good return on investment? So this is where I would turn people in the 2.0 book to our concept of launch capital. Because this is where, what is it going to cost me to go penetrate an addressable market that can be penetrated? But if I spend money to go acquire those customers, will it yield me a return that's worth it? And so we've developed a concept that kind of gives you a guideline of, because most people actually grow their business through their P&L of discretionary expenses of either marketing, people, or tech dev investment. Those are the three most primary, P&L expenditures to grow a company. But those are all choices. Nobody sticks a gun to your head and makes you spend those three things. You choose to spend it in the current period to get somewhere else in a future period. Well, I need to know that my business as it was running is still healthy, isolate the discretionary spend, and hold it accountable to a future return on investment. That, in our opinion, I'm happy, I want to see a return in 12 to 24 months. If a return takes longer than 24 months, you're playing a higher stakes of gambling, and I want you to know it. Now, if you choose to do it, okay, go for it. But we have clients in like personal injury law firms. I mean, it's pretty widely known. It takes average about 3 years in a personal injury law firm for a case to come to settlement for you to get money out of it. So guess what? You got a 36-month growth cycle that you've got to live through to start that feeding engine, to then grow the business.
Yeah. What is a book that you might recommend for our
my
audience?
favorite business book at the moment is a book called Quit by Annie Duke. And so Annie is a professional poker player by profession, but she's also going back to school in behavioral economics to get a doctorate. And I love the field of behavioral economics. I mean, to me, it's one of the most fascinating things. If I was going to go to college today, I'd go get a doctorate in behavioral economics. I mean, it's a more practical, useful area of economics than traditional economics is. And because it blends the true aspect of behavior. The economy doesn't act rationally at times because of human behavior. And I've got to understand the two. And so Annie does a wonderful job of telling stories, the classic stories of behavioral economics that you'll find in some of the other books in the genre, but also adds a few others that I had not heard or read about before. But she does it in a very entertaining fashion and really, helps you understand this idea that as an entrepreneur, guess what? You're a professional gambler. I mean, that's really what you are. And
absolutely,
you've got to be able to count cards, and you've got to be able to know strategically when to bet, and you can't push everything to the center and put it all on red or black. That's a good way to die. But you also have to fight against things like sunk cost theory. And so, I'll give you a good example. Sunk cost is, she tells the story of this guy that was trying to climb Mount Everest, for the third or fourth time, and made a couple of failed attempts, and he had the best guide in the industry to taking him up there. And there's a standing rule that in the final ascent, if you're not past a certain point of the final ascent at a certain time of day, you turn back. It's just hard rule. The only time that guide ever let somebody go past that point, he and his customer died. And it's because you got so invested. I don't know if I'm going to get back. We got to keep trying. And so I get it. I mean, there's a lot of stories in entrepreneurism of grit and that one-off deal. Yeah, and they live to tell about it. Can it be repeated? I don't think so. And it's like, you're going to use that as your strategy? Let's face it. I mean, was it Nassim Taleb? That wrote Fooled by Randomness and in those books. He talks about, the guys in the investment marketplace that would beat him in yield performance when he was a bond trader. And then every 6 or 7 years, he'd see them out on the street busted because they'd gone all in with their clients and lost all their money. And it's because they were playing a high-stakes game of Russian roulette. That you can get away with it for a while, but eventually there's a bullet in that chamber that goes through your brain and you die. And what good did that do you? Yeah. Well, I think when you talk about running a better business, I've got to be able to stay in the game to then take advantage of when the game allows me to gain. And we are entering a marketplace that is unlike any other. We are not going to see an economy that we've seen since World War II that is growth, up. We're going to see an uneven economy that, depending on your product or service, I may be in a good spot. And I'll just leave you with this. Our 100 company model that we track for our own economic data that tells our clients kind of what we see in the marketplace, we're at our, other than COVID, this is the first time that we've seen 66% of those companies are up year over year, 34% are down. So we don't have one economy. We've got an upstairs economy. We've got a downstairs economy. And I guarantee you those 34% that are down are having totally different discussions than the 66% who are up. And you can't have a single discussion. Yeah. You got to look at your discussion in context to your product offering, to the demand of the market, and the projected future demand of the market for your product or service. And that's not even across the marketplace.
Which is the transition out of the
right.
trophy economy. It's now Street Fighter. So how can people learn more about you and your business?
So these is simplenumberscri.com is the website of the consulting practice. So we're an operating unit within Car Rigs and Ingram, but we're, the practice that I had built with my team, we can be found there. If you want to just hear more, obviously both books are available on Kindle and Audible, so I read both of them myself. And then there's tons of videos. If you just YouTube Greg Crabtree or Simple Numbers, a bunch of podcasts I've done, some long form presentations that I've done, that I freely let people, record and put on the web. And we've done obviously some of that content ourselves, So I've looked at it more so that as I said, my mission is to elevate the entrepreneur. And if I try to put everything behind a paywall and charge for every little thing, a piece of nugget, I'm not accomplishing my mission to really elevate that entrepreneur. And so, but we've tried to put material out there that if you want to self-implement, there's a lot of good stuff out there that you can learn and get ways on your own. But as all concepts and things, there's things that we bring to the table that we can help with if you get stuck and you're not a self-implementer. And so certainly, feel free to reach out, and there's a contact form on the webpage, or you can email me directly at greg.crabtree@simplenumberscri.com, as well. And I'm on LinkedIn, so like I said, I'm probably not the easiest person in the world to find. So not too many Crabtrees in the world. So
thank you, Greg. No, Greg, what haven't we discussed today that you wanted to cover off?
Tons of things in terms of understanding, business value concepts. What is my goal of, we've come off of this drug-induced high M&A activity, and that was just kind of a temporary season for a lot of reasons, and so you really got to understand. Somehow, someday, some way, you won't own your business. And so I've got to understand if I'm a harvest business, I better be harvesting profitability and diversifying wealth away from the business. That business will serve me as a good income engine and great return on investment. But there's characteristics about certain businesses that will never get you a premium of a sale. Doesn't mean they're a bad business. A lot of my best clients are those types of businesses. But if you've got that business that there continues to be an interest in sale, I got the best of both worlds. Run it profitably, and hey, when I'm ready to not run it, somebody's going to pay me a nice premium that economically it's a good decision whether I keep it or sell it. And that's where you want to go.
Yeah. Lovely. Greg, thank you so much for your time today. And again, thank you for sharing your insights and wisdom around your purpose of elevating the entrepreneur. It's had a material impact on our clients, that's for sure, and obviously many others all around the world. So thank you again for both of those things. I really appreciate your time today.
Hopefully I'll get back to Australia soon. So looking forward to it. One of my favorite places in the world.
I can understand why. Thank you, Greg. Well, I hope you enjoyed the episode as much as I did. If you'd be kind enough to leave a review for the podcast, that'd be really helpful to other like-minded entrepreneurs, and then we can grow our community. If you want to find out more about our guests, head over to evolutionpartners.com.au/podcast, where you can find show notes and other additional reading. Hope to see you back next week. Until then, keep thriving.